Hello and welcome to Climb's podcast series Advancing Vietnam with me, Vlad Savin, as your host. Throughout the following episodes, we're looking to answering relevant questions about doing business in Vietnam. What are the opportunities and challenges faced by investors entering the market or existing players in major industries? We will seek to understand the business environment from a cultural, local mindset and how to deal with compliance from an international perspective. What are the major risks faced by businesses active in the region and how to overcome them? We will dive deep into the compliance environment in Vietnam, discussing processes and procedures, changes in laws, latest official updates from the authorities, and financial governance planning for businesses active in Vietnam. We at Acclaim consider compliance a major asset for foreign investors operating in Vietnam. We emphasize this aspect when speaking with our clients, and we make sure they understand the significant benefits of being compliant. In this episode, I'm discussing with Matthew Lowry, managing partner at Acclaim Vietnam, about the transfer pricing provisions in Vietnam. We will cover the current regulations in regard to transfer pricing, outlining specific elements regarding the TP documentation, guidance on tax deductibility of interest, application timeline, and opportunities for savings. Matthew, welcome to our 13th episode of Advancing Vietnam podcast series. It's a lucky number today for our technical transfer pricing discussion.
Great to be with you again, Vlad. 13th is hopefully lucky for some.
Let's see. Matthew, in Vietnam, the transfer pricing regulations can be somewhat confusing and opaque, and international investors are many times unaware of their responsibilities and opportunities alike. Before we delve into these matters, can you explain the generic concept of transfer pricing from an international perspective?
The good thing is I don't see them as opaque as they were. Vietnam has moved in recent years, and only in recent years, to a much more internationally aligned OECD approach to transfer pricing. So transfer pricing is fundamentally the shifting of profits from one jurisdiction to another jurisdiction to avoid taxes. That may be moving from a high tax to a low tax, or simply avoiding tax. And from a single government perspective, is simply tax has not been paid on what they believe should be a reasonable profit in that country. So we're looking at a country in isolation, but within a global context of, have you paid tax that you should have paid, an arm's length return for investments between related parties in that country, or have you been pushing your profits to another jurisdiction, to another related party?
And how does this principle translate in the Vietnamese context and business environment? How do the authorities here interpret transfer pricing provisions?
So, as I said at the start, we've moved to a much more OECD style. Historically, it was more based upon general anti-avoidance provisions. Is it commercial? Does it make sense? Now we've got our proper foundation since Decree 20 a few years ago, and now moving into Decree 132, is that we have a foundation for the methodology and the process for understanding what an arm's length price should be, to make sure that companies with related parties are earning sufficient margin on those transactions in Vietnam. And it really comes down to enforcement, it comes down to the methodology that you use, and it comes down to protecting. And there are some safe harbours and some easy way outs, but the authorities do go through. They are looking at businesses that have higher risk, and they're trying to identify related parties and make sure that the margins and taxes are being paid in Vietnam. And just remember, Vietnam's not a high tax jurisdiction on the surface. If you are not careful, the tax rate can effectively increase by virtue of penalties, etc., if you're not following the rules. So in some countries, Vietnam was seen as an easy target. Now it's much harder because we have this internationally aligned transfer pricing process.
As you mentioned before, on 5 November 2020, the Vietnamese government released Decree 132 in respect of transfer pricing in Vietnam, replacing Decree 20 and Decree 68. This new Decree 132 provides some significant changes to transfer pricing regulations in Vietnam, and although it comes into effect from 20 December 2020, it applies to the full 2020 tax year. Therefore, entities with related party transactions would need to ensure understanding and compliance with these regulations. This decree broadens the definition of related parties and also reduces the arm's length price range. What do these elements refer to? Can you explain?
Yeah, the Decree 132 was sort of it wrapped up a lot of what happened in Decree 20. There was amendments and there was clarifications, and then there was Decree 68, which was predominantly on interest changes. And the latest decree sort of is a wrap up and a few changes to tighten things, but we've got a single source now. That is, in the process, we've now gone, since we first introduced transfer pricing, to approach where your arm's length range, what they regard to as commercial, it needs between 35% and 75% of what others pay. So you can't say you're on the lowest end of what that you're in related parties pay less than what independent people pay. There has to be consistency. And so it's just giving the range of what is acceptable margin, so that when you prove that you are not pushing profits out, you're not transfer pricing, you are just charging the market price, the range has been narrowed. And they want to push people in effectively to the middle of what everyone else pays. Is that what related parties should be doing? Because you need to pay your profits on those here. The other part was the related parties. So we've got a concept now where it's not just about ownership, 30% ownership, it can be control, it can be if you have no ownership relationship but you trade with one international party that represents 70% of your business, you can be caught. So they've tightened both the idea of ownership, control, trading, and they've further broadened and said it's not just you and your grandmothers and your grandkids. They've really broadened that sense of trying to bring the related party from a definition, because the family unit in Vietnam is quite broad. They've actually said you can't just put in other people's names to get around, and in other countries, that ownership. So ultimately, Decree 132 has said that we have a broad ownership related party concept of who will be subject to it, so dealings with related parties. Narrowed this idea of what's acceptable pricing. It needs to be trending towards the middle of the average price you charge others. And if you do that, you're within that, follow the rules. If you can follow those processes, and it sounds complicated, and we'll go through some sort of examples a bit later, you can just do what you need to do. If you're outside of that margin, or if you've got related parties and you ignore, that's when you're exposed. So just to go on the related parties, is that if you trade with related parties, you must make sure your margins are arm's length. And if you've got arm's length margins, you won't be accused of shifting profits to offshore. And effectively, that's what we're talking about.
Right. Are there any exemptions in Vietnam regarding the preparation of the transfer pricing documentation?
There's a number of exemptions in the decrees that have come through. So the first one is that you don't have to be subject to the transfer pricing legislation if you're under 50 billion turnover and 30 billion related party. So effectively, if your turnover is less than 2.2 million US dollars, you're not, and your related party is less than 1.2 million US dollars, you're not having to comply with the requirements. You've still got the general anti-avoidance. You can't just do things anti-avoidance, but you're not subject to the required documentation that others would be as far as the transfer pricing. That's the first thing. You've got then the second option where you can look at, I'm under 200 billion in revenue, and then you can use, if you fit into one of the simple categories. So you've got this idea of a 5, 10 or a 15% simplification in what you can do. You can use 5% if you're doing distribution. So related party distribution, provided it's nothing more than distribution, you're a simple business under that 200 billion, 5%. If you're manufacturing, you can use 10%. And if you're processing, you can 15%. And that allows you to just say, I've got a threshold. I don't have to do any studies to justify. I don't have to have all my documentation because I can fit within these thresholds. And lastly, if you don't want to go and do your country by country report and all the other reporting there, you can do an advanced pricing arrangement. And that advanced pricing agreement, the advanced pricing agreement is an arrangement with the authorities in advance saying, this is how we do our processing, this is how we offshore, onshore, this is how we do our business, getting agreement. So then you're not having to deal with inspections and questioning your business and the agreements. It's done up front. And that's not so easy, but in many, for complicated businesses that are over those thresholds, that can be a much easier way to do things.
There are certain tax deductions for interest expenses and carry forward interest deductions for future periods. How do these apply?
Yeah, so part of the transfer pricing, and it's connected, but it's also separate, but in Vietnam we've put it in as one, is that interest deductions cannot be more than 30% of your EBITDA. So that if you're a highly leveraged business, you're not going to get your deductions unless you're making lots of money. So it's effectively a thin capitalization to make sure that you've got enough capitalization. Your investors are putting enough money in, and you're not sucking out profits by way of interest. So interest there. So if your interest expense is greater than 30%, and it was 20% when the transfer pricing started, and they moved it to 30%. If your interest deductions are greater than 30%, you can carry forward the undeducted interest expense to future periods. So you don't lose it, but you're denied to use it in that period. So even though it's not technically transfer pricing in the rest of the pricing process, it is using thin capitalization and transfer pricing together to stop profits being shifted outside of Vietnam to related parties.
And based on the cross-border entity structure of an organization, there are specific provisions in respect to the responsibility for preparing and filing reports. What are these country-by-country reporting requirements that you mentioned before?
Yeah, so you've got different levels. So you've got the parent reporting, you've got country-level reporting that you need to do. And so the country-by-country report is essentially a Vietnam country report would be your profits in Vietnam and the comparable benchmarks against that, how you do it, your transaction undertaking, and your comparable benchmarks. And there's a number of ways to get those benchmarks, and there's two predominant databases the Vietnamese authorities use, but you can use other comparisons. So we won't go into the sort of OECD approach and the main methods that determine comparable pricing, but the idea is your country-by-country report needs to go through those and how those work. You are to file them each country, and if you're the parent in Vietnam, which is sort of unusual for our client base, but you may have to lodge, if you're over the 18,000 billion, you've got to lodge the parent company report as well as the country reports. There are exemptions for filing if there's certain data transfers, but from a Vietnamese perspective, we generally assume that they don't exist, so there is a manual filing required for those. And those country-by-country reports take time to prepare. They're the most complicated, not only getting the data and getting the comparable pricing methodologies, but also just preparing them and making sure they are done.
What are the deadlines and time frame for submitting this transfer pricing documentation?
So you've got a number of things here. One is you've got to declare your related party transactions when you lodge your tax return each year. So 31 March, you are related parties, and who are the related parties and what transactions do you have? Your country-by-country report, you've got 12 months to lodge them, but keep in mind, if they're doing an inspection, you have to submit them within 30 days of the request. So I would never encourage someone takes that 12-month period, because you need to know your basis for doing it anyway, and you can't just do the report to justify what you've already done. So always prepare as you go, have them ready when your taxes are being done, so that your related party declarations match your country-by-country report and your calculations, and then it needs to be in Vietnamese language. So when we see inspections and people who haven't prepared a country-by-country report and try to quickly pull it together, 30 days is really tight. So even though they were not in breach of their deadlines for lodging, that inspection triggers a time frame which is shorter, which can be very, very tight, and may prove that what they were doing was not compliant in the past and they don't have an ability to rectify.
Right. And final question, what are the next steps foreign investors should take in regards to transfer pricing based on what you shared already, in order to clarify their obligations and compliance, and also to better understand their potential tax savings?
Yes, so my starting point is always understanding where you stand. It's not get straight into a country-by-country report or a pricing methodology, justifying your pricing methods. That's step 2 and 3. The first step is get a general landscape exposure. Who are my related parties? What are the nature of my transactions? How are they supported? What are we doing? Where do we stand? And do we have a risk? Are we over the thresholds? Where are our safe harbors? Can we use the 200 billion? Can we use the 50 billion thresholds? Where do we sit in the picture at the moment? And what implications does that have to my tax structuring? With that, it might be that you reduce the amount of transactions, because there is another safe harbor, which is if the transactions between two Vietnamese companies of the same tax rate, they're exempt again from the actual transfer pricing documentation. where foreign parties are always included. So there are a number of ways where if you're just over certain thresholds, you may not need to go to a country-by-country report or a full documentation, because you may be able to somehow restructure it if that's the most cost-effective way. And it really is understanding exposures, understanding relations, understanding where it is. Once you have that, you can then make a decision to do the reporting. And I've seen clients come in with a very low margin saying, I will do a cost plus margin of a very low amount, and you know that's not going to work. And so we encourage in those situations straight away people to revisit those numbers. They need to be commercial, because if you end up doing a study and find out your margins were considerably lower than the market, you've got an exposure, you've got a problem, and it's very easy for the authorities to see. So it's at the earliest stage, get an understanding of what you are, where you are, then work through benchmarks, work through your studies and documentation, but don't just jump into that, because it may not be necessary, or it may be pushing you in the wrong direction.
Matthew, thanks again for this really insightful introduction on transfer pricing. Quite a technical topic, but a lot of foreign investors, some of our clients as well, need to be aware of all these provisions.
Always glad to talk, and yeah, it's quite technical, but it's necessary. It's something that can't be avoided, and I think investors need to understand and focus on it as an obligation and a necessity in Vietnam to understand.
Exactly. The new decree released in 2020 on transfer pricing regulations signaled the Vietnamese authorities' focus to align the TP compliance prerequisites with the international standards, and to monitor more strictly the related party transactions of international investors based in Vietnam. That's why we encourage all foreign invested businesses regarding of size to review and be aware of these provisions and make sure they remain compliant. And many thanks to you, our listeners, for tuning in to Advancing Vietnam podcast series. For more information about this topic, please check out our publications on vietnam.acclaim.com. And if you want to reach out to us for any additional details, feel free to contact me on LinkedIn or throughout the website contact details.